Greetings. Thank you very much for joining us today. My name is Matthew Pillmore. I'm president of VIP Financial Education. And I was just saying moments ago to our special guest how excited I am about today's training. It's known as our Real Estate Investing 101 class. This class is perfect for somebody that really just wants to understand the ins and outs of real estate investing, how to build long-term wealth one house at a time. So you really just have to be able to understand that whether you want to own one property or whether you want to own 10 properties, it really doesn't matter. This is going to be something that you will find valuable. Also, we want to start talking a little bit more in detail about how to apply cash flow stacking in order to expedite your goals. Now, cash flow stacking is something that we addressed very briefly in our 100% debt-free for life training. If you haven't seen that class yet, make sure you check it out. It'll show you how to own real estate mortgage-free. And Charles, you've seen that class several times. So let's go ahead and dive right in and explain what the purpose of this class is and what we get out of it. Really, all we're after is your feedback. We're here to provide an ongoing curriculum of courses that will help you maximize cash flow, and real estate just happens to be a great way to do that right now, but we want to know what you think about what you get today. And in exchange for that, we're going to give you some special gifts, so hang out at the end and we'll explain exactly what those are, but it'll be well worth your time. Now, before we dive in and I introduce our special guest, I do want to point out that their company, Your Castle Real Estate, does have an A+ rating with the Better Business Bureau. We always do a thorough background check, and I happen to know today's presenter very well, and they're exceptional. In fact, they've created a proprietary software tool that can navigate the best markets on a quarterly basis in the Denver metro area specifically, and it is phenomenal. As real estate investors, you will not find a real estate investment agency that's better than Your Castle. Let's go into today's presenter and give you a little background on Charles Roberts. Charles Roberts and I have known each other for a very long time now. He's the co-owner of Your Castle Real Estate in the Denver metro area. They have 5 offices right now with over 360 agents. He's owned rental properties for the last 13 years. He's done many fix and flips along the way. He's a registered agent, a registered appraiser. He's been in the lending industry for a number of years, and he's doing exponentially more deals every year than the typical agent. And this is the reason that we set our sights on Charles for teaching today's class, because he does specialize in the real estate investing, purchasing world. And he actually even hosts one of the largest investment conferences here in the Denver area. He was a commentator on 630 KHOW. We did a lot of radio together about real estate many years ago. Charles has been interviewed for numerous big stations here in the Denver area, including 9 News, 7 News, Nightline ABC, Colorado Public Radio, and he is one of 13 directors of the Denver Metro Association of Realtors, which has over 5,000 inside that organization. So that is not small time. You can see why we brought him in to do today's class. So you're learning from the best. Now, the reason our curriculum is so compatible with what Charles is going to teach you today is because Charles believes that this happens to be a wonderful time to buy and hold cash flowing real estate. And we're going to get into that in great detail. Now, before we jump right in, a couple housekeeping details that we must cover. The presentation is just for educational purposes, so numbers will be estimated conservatively to simplify the training. You're going to love everything you get today, just like all of our classes. The training is not, however, a substitute for financial, investment, legal, or tax advice. It's also not a promotion for either of our products or services. It's strictly for educational purposes. Now, for guidance pertaining to your specific situation or the governing laws in your state, please do consult with a specialist in your area, and we can help guide you in the right direction with that if needed. One last thing, and one of the gifts that you're going to get for making it all the way to the end of today's training is a free counseling session, which is included with today's class in order to help you safely get involved with real estate. And Charles and his team has graciously agreed to provide that for you. So I will explain how you can take advantage of that when we reach the end of today's training. One last item before we dive right in and start discussing a very enjoyable topic. You're really going to want to commit your undivided attention to this class. It's absolutely needed. So make sure you turn off your phones, remain distraction-free. I recommend taking notes and writing down your questions so that you can get those answered during your individual consultation. And there will be several gifts at the end if you're willing to give us your feedback form. And that will be electronically pulled up on your screen, so you can just go ahead and complete it right there at your computer. Now, before you can answer how to get involved in real estate, whether you've already purchased investment properties in the past or whether you're interested in perhaps pursuing your first, it's important to answer the question, why? Do you agree with that statement, Charles?
Oh, absolutely. Whenever I work with a client, I always make sure we have this sort of discussion on why do you want to do this? And that's what we're going to talk about right now is why would people want to buy and hold real estate?
Okay, so I can think of a pretty obvious answer to that question. What would be your first answer to this why question?
It's probably the same thing you're thinking, because you can build wealth over time. It's just really that simple. There's a lot of different ways that you can invest in real estate. What we're going to be talking about today is what I have done in my career and what I work with clients is building wealth over time in a very predictable, unsexy sort of way. And that's what makes sense. That's why we're talking about this, and this is why I do this with my clients.
So let me interrupt you there for a moment because you said build wealth in an unsexy way, and yet I would argue that get rich slow is the new sexy.
Call it anything you want. There's two basic ways people try to make money in real estate. They try to do fix and flips and make $50,000 in 3 months. And then there's the other group of people who buy property that makes sense, they rent it out, they deal with the problems that come up, and they build wealth over time. And that's really what we're going to talk about is the latter, simply because that's what I like to do. I've had 88 closings so far this year, and most of my closings are for normal people who have some extra money and want to take some of that money and diversify it and build wealth over time. And essentially, we're on track for most of these people to pay them off in 13 to 15 years. So if you're 30 years old, you buy a $150,000 place, you pay it off in 13 years. If it goes up about 6% per year, which is average over 13 years, you're going to have something like maybe $225,000 worth of assets in 13 years owning that one property. That's what makes sense to me, and that's what we're going to talk about today.
And that's if you choose to stop at one. We've got a really special treat for you a little bit later in the presentation, showing you how you can actually expedite that result far more quickly if you chose to, if you didn't want to stop at one. So we'll get into that a little bit down the road. So you're talking about wealth development, and my understanding is that real estate has been a contributing factor to ultimately the largest development of wealth inside our country. Is that a true fact?
Yeah, that is actually true. There are more millionaires built on real estate than on anything else. This is not a secret. Real estate over time goes up about 6% per year. We're going to certainly talk about what we've seen over the last couple of years. And that's actually the next point right there. We had a large downturn the last 4 to 7 years, depending upon what part of the country you're in. And what's happened is there has been an enormous transfer of wealth during this downturn. And you have to go all the way back to the 1930s during the Great Depression to actually have a larger transfer of wealth than what happened right now. Unfortunately, a lot of people lost a lot of homes in the last, say, 6 or 7 years. What happened is prices went down, and over the course of the last several years, another generation of investors have been purchasing these for the long term, buying them at real values, paying them off over time, and that is going to see an enormous transfer of wealth to these new investors.
That's really interesting, probably something you want to participate in, I would imagine. And you know how we feel about the banks here at VIP, Charles. It would be safe for me to assume that there is a significantly better return on an investment by pursuing real estate than what you could get from any tool in the bank. Is that a fair assumption?
It's a fair assumption. So let's say you want to open up a savings account. What are you getting? You're probably getting about 0.25%. If you do a CD, if it's a really great 5-year CD, you're probably getting about 1, maybe 1.25%. My folks are getting about 20% return on their money. And we're going to talk about that more. Some are 30 to 35, some are in the maybe 15 to 18%. But any way you look at it, if you want to be more of an active investor, not just buy a bond, but actually buy a house and do the work required to own that house, the return is enormously larger. And that's why you're probably listening to this, and that's why another half an hour we're going to tell you more about it. This is why people are doing it, because there is an enormous potential return for doing something really rather simple, buying and renting a house.
So I think earning money is probably the why for most people. Nobody is landlording because it's a lot of fun. The money has to be the attraction for almost everybody. So what would cause somebody in a market that's proven itself to be very profitable to decide against real estate? It would probably include the risks, right?
Absolutely. And this is what I'd like to talk about a lot. And let's just get this out of the way. This is not some sort of late night discussion that you're seeing on cable. This isn't you can go to Florida, you can go to, Maui and make millions of dollars and hang out by the pool. It takes work, and there are risks if you want to be a real estate investor. If you don't want to take any risks in your life, then you shouldn't do this. And I would beg you not to get yourself in trouble, because a lot of people do think that this is just easy and it's fun all the time. And the fact is, give me a call. I will tell you about some unbelievable situations that occasionally I run into once a year or once every 5 years with one of my properties. So do understand, owning real estate is an active investment. It is not like a bond. You want to buy a bond, you get 1%, it's not active. You want to own real estate? It might take a little work. You might make 20 to 50% though, and that's why you want to do it. It's not without risks. You're going to have some bad days. Now that said, I've had lots of tenants. I will tell you that I might have one bad day per year per tenant. It's something like that. It's not every day, but you're going to have some. You're going to have some tenant complaints. Someone's going to have a leaky roof. You're going to have a lawn that needs mowing. You're going to have some vacancies once in a while. Just yesterday, one of my tenants called me up, and just so you know, I manage my own properties, and he said, you know what, my fridge isn't working. And we had talked about it for a while, and I said, hey, no problem. I'll go get you a new fridge. Not a big deal. It's a $200 fridge. I'll take care of it. But you're going to have things like this. Therefore, you should make a good return by making this a part of your life. And if you do this correctly, you will make a great return. But in the end, what I ask you is that you decide, does it make sense? Do you want to do this? I think there are plenty of people who really just shouldn't buy investment property. It's just not part of their lifestyle. They don't want to get a phone call from some guy saying, I need a fridge. For me, I'm okay with that. I make a lot of money from it, and that's up to you to decide if it makes sense to do this.
I couldn't agree more. I would say probably the most common objection that I've heard from our student body about why not getting involved in real estate happens to be, it boils down to the headache. And a close mutual friend of ours, which is a very active real estate expert, he argues that cash flow is the aspirin that solves all landlording headaches. The more money that you have cash flowing every month, you can just throw money at almost any problem. When you talk about the lawn needing to get mowed, when you talk about a leaky roof, when you talk about a hot water heater that just went out on one of my rental properties that ended up costing me $1,400, which is probably $700 too much, but the property cash flows $900 a month. It's very easy to make decisions like that quickly without allowing it to interrupt your day-to-day life. And again, the headache is very short term, and that's a positive thing to keep in mind when you're considering real estate. People who bought based on speculated appreciation were the ones that got themselves into trouble. The people who purchased based on cash flow on a monthly basis seem to really minimize and reduce the risks that you were describing there, and that's been my experience as well as a real estate investor. What do you think about that?
I 100% agree. What I would advise you listening to this is don't think that you're so smart that you know when to buy, that someone says, oh, this is the neighborhood to buy. The fact is, the market is pretty liquid. What I advise my clients to do is, do you have a 15-year plan? Do you want to buy a property and have some good times, have some bad times, and over a long period of time make a lot of money? Almost certainly. That's what I would advise you to ask yourself. Thinking that you're so smart that you know which house to buy or which condo complex is going to go up, in my experience, we're not that smart.
Okay, but you're speaking specifically about the potential of appreciation, not necessarily addressing the right and or wrong about purchasing a property that does or does not cash flow. Because I saw people make significant sacrifices towards their cash flowing a property on a monthly basis 5, 6, 7, 8 years ago. And those are the ones that ended up in trouble. And I've done it before as well. I've made mistakes along the way. I even short sold a fourplex that I bought because it was negatively cash flowing and it had dipped in value by half. It lost $180,000 in value over a 6-month period of time. And I made the mistake of buying based on speculated appreciation. What do you tell somebody about the concept of buying based on the here and now of cash flow as opposed to the potential of this property might be worth something that it isn't right now.
I agree with you 100%. What Matt is saying is don't take major risks. Don't buy a place that's minus $300 a month because you think it's going to go up 20% next year. Let me tell you right now, you have no idea. What we're saying is the same thing. Buy properties that make some sense, that are conservative, that cash flow something, because a furnace is going to go out every couple of years. Something's going to happen. My advice in real estate is be as conservative as you can, because bad things sometimes happen. But if you're conservative, if you have positive cash flow that you're building up, you will be able to overcome any problems that come along. You'll pay it off and you'll have a lot of money. That's what my clients are doing. And if you ever give me a call, that's what I'll tell you that I've been doing, and I'll show you what I've been doing. And one of the questions you're going to ask me is, Charles, you're kind of a busy guy. What the heck are you doing managing your own properties? And that's what Matt was chatting about. I teach a class with one of our colleagues, and we kind of just talk about this for 2 hours because he doesn't manage his properties, and I do manage mine. Fact is, it doesn't take very long. I like to be involved. I want to know what's happening. It's a decision I've made. In the end, if you buy some properties, you're going to make that decision. But just so you know, 13 years later, I'm still managing my properties because I prefer to do it that way.
And it's all about a cash flow factor.
Yeah, absolutely.
Because if you don't want to manage it, you're just paying somebody else to do it.
Yeah, I can pay somebody 10% to do it, and I can actually make an argument that I probably should be having somebody else do it, but frankly, it's just not that hard, and I want to know what's going on, and this is a lot of my retirement, and I'm a really active guy. This isn't a bond. This is a job. It's a job that maybe takes me an hour a week, but it's a really important hour a week, and I have a lot of money tied up in my properties because I've owned them for a while, and I want to make sure they get taken care of.
So some people would argue, Charles, that this is one of the best markets that we've ever seen. There are a number of different elements that need to be considered in order to make that decision, and it's probably a subjective determination, but I'd love to at least consider those 4 factors with you. So what would you consider to be a perfect market?
Okay, so let me talk about an irony, because just a couple of minutes ago I said, don't go chasing some market, don't go chasing some condo. Just be conservative, buy something that has cash flow and pay it off. But your question is, what would a perfect market look like? So let's talk about that for a second. I look at it in 4 different factors. I think a perfect market to buy in would have prices that went down over time, which clearly we did. So our prices, depending upon what part of the country you're in, probably peaked around 06, 07, probably have gone down for 3-4 years and might be coming back. So just think about it. You'd like to buy when prices went down. That would be a good start. In terms of interest rates, well, since what we're talking about is owning property for the long term, what I would like to see are interest rates as low as possible. And here's the deal. We don't just have 50-year lows for interest rates right now. We are at record lows. And this, more than anything else, if you forget everything else we talk about, this is the one that's most important. Locking in a 30 or 15-year loan at the current interest rates keeps your payment so low for the duration that you own this property. This is the most important thing. This is a really, really big one, and clearly our interest rates are low, and this is what's making it very, very attractive to purchase these properties. And by the way, this is exactly why interest rates are low. The Fed is putting billions and hundreds of billions of dollars to buy bonds to keep interest rates low, so you go out and buy these properties. This is exactly why the Fed has taken so much money to keep the interest rates low. It's to make people like you interested and say, my goodness, I can own this property for this much a month forever? Yeah, I think I'll do that. And here's exactly where the rubber meets the road.
Well, until it's paid off, at least.
Until it's paid off.
Then you own it for a lot less every month.
Much less. Then it's just your taxes and insurance. So what else? What other thing would I like to see in the market? How about vacancies at a relatively low rate? And that's exactly what we have right now nationally, because what has happened over the last few years is that people haven't been able to purchase properties because they lost their property or they lost their job. It's a very sad thing, but what it has caused are a vacancy rate nationally that is at a record low. People either buy homes or they rent homes. Right now, they're renting homes. So if I had to ask what would be a perfect environment, it would be when vacancy rates are low, and that's exactly what we're seeing right now.
So far, so good.
And
What's the final?
The final one is, well, rents. I mean, obviously, rents are your income. So you'd like to be buying and you'd like to be owning in a period where rents are going up. And once again, we happen to find ourselves in a position where, because there are many, many people who can't buy or are too scared to buy a house, they're renting. Well, that's a simple supply and demand. What that's doing is it's dropping the vacancies and it's increasing the rents. And once again, nationally, in almost every market, we have rents going up right now. So if there was a perfect example of when you would want to buy, this is what it would look like. The fact is, it looks a lot like this right now. Not a bad idea to be considering doing something like this for the long term.
Personally, I have found real estate landlording to be pretty darn easy right now. If I were going to try and describe a market that I would want to get involved, because I'm a lot like most of the real estate investors that I speak with, which I can't say I love landlording. It's not the top of my list of things that I find enjoyable, but when you describe the potential wealth development over a long period of time, it's irresistible. So that's, I look at what you're describing here and I say, no wonder it feels so good right now.
Yeah, I mean, in our market in 2003, we hit a high of 13.1% vacancy rate. Our vacancy rate right now locally is 1.5%.
Okay, that's pretty tough to beat. So properties just aren't sitting empty. Now, what we want to try and do here, Charles, for the listener is help them understand what is the A to Z roadmap for getting started. And I try and break most of my processes down to 7 steps if possible and keep it consistent with most of the education we provide. So we've done that with the 100% debt-free for life class. We've done that with the business credit and funding secrets class. So let's go ahead and work together to put together a 7-step map for the listener in order to understand if I fall off the fence on the side of I'd like to move forward with buying another property, whether it's my first or my 10th, what should I expect to experience? Does that sound good?
Yeah, so here are the steps right here. The first step for you would be simply to contact an expert to counsel you through the process. You might be saying to yourself, this sounds kind of interesting. Yeah, maybe I want to learn more about it. That's exactly the first step, is learn more about it.
And I didn't mean to step on you there, but you're gonna give people an opportunity to either help them with this yourself and counsel to some extent at no charge, and then also guide them in another direction if you're not the perfect person for the job and they're somewhere else in the country. Is that right?
Exactly. So
Okay.
I'm going to invite you to give me a call. I talk about this stuff all day long with people, and I'm happy to chat with you. The fact is, I work in Colorado, so if you're someplace out of Colorado, I'm not going to work with you because I can't, because I'm licensed in the state of Colorado. But I know people around the country. There are people just like me in every market who are experts in buying, holding types of properties. But that's the first thing you want to do, is frankly learn more about this.
And you're willing to help answer some of the initial questions somebody might have, even if you steer them in another direction, right? That's what we were talking about.
Of course.
Okay.
I mean, I get a pleasure from doing that. You give me a call, we chat about it.
Fantastic customer service, by the way. I cannot speak highly enough about Charles. We actually had a conversation recently about people that, for whatever reason, the new trend, not calling people back. Charles is the exception. He is phenomenal. So you guys, that is a huge gift. Take advantage. Step 2.
Okay, so working with all types of real estate investors, what I always tell people is the thing that you're going to spend the least amount of time doing is the thing you should spend the most amount of time doing, which is to understand your lending options. Now, as it happens, Matt and I have been lenders in the past, so we understand this very well. Trust me. You're going to go out, you're going to try to find the best property, you're going to spend a year trying to get $10 off a property. What's much more important is that you understand your lending options, that you get yourself in a position to be able to maximize the rate. This is really where I want you to spend some time. Contact a lender and force yourself to understand that you're going to own this property probably and pay it off. Maybe you pay it off in 5 or 10 years, who knows what. But it is critical that you do the work to understand your position, that you make yourself as good a loan recipient as possible. This is where the big money is. This is step 2, and this is where I'm begging you to spend more time than you think you should.
So we'll guide you in the right direction on that if you don't have somebody that you're loyal to already. What is the 3rd step in this 7-point roadmap, Charles?
It's really to learn your market, to understand what your market is doing. Now, the thing is, though, you've got to be a little careful here, because you can learn your market And you can certainly learn what your market's done in the last quarter and the last year. I'm an expert at my market, and I'm telling you, I can't tell you what's going to happen in the next 3 months, and I'm the first one to admit it. So learn your market, understand your market, but don't think that you know or that any realtor you talk to knows what's going to happen in the future. The bottom line is, over long periods of time, residential real estate goes up about 6%. Sometimes it goes down 20%, sometimes it goes up 30%. There is no way you're going to know what's going to happen in the next year or two, and that is a risk. That's something you have to consider. That's why Matt said a few slides ago, be conservative. Make sure you've got cash flow. But regardless, learn your market, understand what's going on, so you're walking into this with as much knowledge as you possibly can have.
So realistically, if we were considering a timeline on these first 3 steps, Charles, what would you say would be a reasonable amount of time to spend on these first 3 steps?
I don't know, a month or so. I mean, if you really work at it, you could probably do it in a week. I'm assuming most of you are normal people like we are. You have jobs, you work during the day. This is something you're talking almost as a second job, almost as a second career. Give it a month and don't rush. And by the way, just don't rush. Don't work with a realtor who says, well, we got to buy this in the next 7 days because here's what's going to happen. That right there is a really good indication that that's not somebody you should be working with. You should be working with somebody who has patience, who understands that it takes a while to learn this market, and also what you need to do next, which is begin to make some offers. So you have a lender ready to back you up, you learn the market, then you go out and you start actually looking at properties, making some offers, and hopefully working with a good realtor who is going to represent your interests as well as he or she can.
And it's not unusual to have to make multiple offers, right? So if you didn't get an offer accepted, you shouldn't allow that to discourage you from pursuing the goal of obtaining more real estate, right?
My average is 18 offers per closing. Now, that's just me. That's what I do with my clients. It may be more for you. It may be less for you. But for what we do, we're right about 18 offers per property that we close.
Persistence, consistency, determination, sticking with it, a really important piece to this if you want to get from step 1 to step 7. I've gone through this myself over and over again, and it is just not enjoyable. I said it before. I mean, buying property for me is not an enjoyable experience. It's frustrating. It's very stressful. You can't help but get emotionally involved with the experience. And I want to encourage you listening that if you're going through this and you haven't been through it over and over again in order to desensitize yourself to some of that, that's normal. Wouldn't you agree?
Not really. To be honest, most of my clients actually enjoy this. So
okay.
I'm looking at Matt saying, I don't know what to tell you. Most of my folks actually enjoy it. But I'll tell you, something about me, I'm going to just tell you a little secret about myself. I can't screw in a light bulb. Most of my clients actually can put up doors and they can do all sorts of handy stuff. And they actually enjoy this way more than you might think. As it happens, I'm just completely useless with my hands. But even I kind of like doing it. It all comes down to who you are. Some of you might not particularly like this. I think a lot of you might actually enjoy the process. It just comes down to who you are.
On a side note, Charles does have on Velcro shoes.
I'm also a bit cheap, and Matt likes to make fun of my $10 Walmart Velcro shoes.
I think. Okay, so what is the next step on this roadmap, Charles?
So once you get a property under contract, you're going to want to do a professional inspection. And unless you are a professional inspector, which is pretty unlikely, hire someone, $150, $200, $250, do the right thing. Get all the inspections. Make sure that you're buying a property that is as fit for you as you possibly can. Your real estate agent will be able to help you with this. Just make sure that you've done everything you can to vet the property.
I mean, that is a dangerous step to avoid.
Yeah, I have a couple of clients who, I've got one guy who's bought 18 properties and held them. My record, I think the top one I have is 23. These guys are actually inspecting their own stuff now, and I'm okay with that. But really, 99% of everybody out there and the people I work with, hire a professional inspector. Make sure it's the right property for you.
Excellent advice. 6th step.
Well, this is really where it gets interesting, is the loan process. So you've already figured out that you're now as capable of getting a loan as possible. You're working with a good, solid loan officer. What happens for the last couple of weeks after you're at inspection is you're going through the loan process. And it's not quite as easy as you might think, even for folks who are very qualified. The lending process is the lending process. It's a step. It's what you have to get through. All I can advise you is if your lender wants something, give it to them. If they say, I need this, don't say, I don't like you, and don't say, I'm not going to give it to you. The poor lender, the lender is just getting requests from his underwriter, and they have to get this. So it's a process that needs to be gone through. You're going to go through it. It's not going to be pleasant the whole time, but it's step 6.
And step 7, right? Time for celebration?
Exactly. Then you close on the property. And I will tell you that in my market here, we're generally getting properties rented before we close. It's a little game we have to see if we can do that. So once we get past inspection, we usually have a couple more weeks to close, and we'll start putting up for rent signs and putting stuff on Craigslist. Simply because our vacancy rate is so low and our rental market is so strong, we generally can actually have somebody ready to go by the time you close. That's pretty cool if you can do that. If you can't, if it takes a few weeks, that's fine. So you close the property. Maybe you actually have to do some work before, maybe you don't, and then you get it rented, and then the cash flow starts coming in.
So can we go through a case study together?
Yeah, absolutely.
Great.
Okay, so this is a property, and I actually have the address here. So it's 18915 East 16th Place in Aurora, Colorado. So it's a property that a client of mine bought. So let's just talk about it. We bought it for $95,000. It's actually an attached property, so it's on a cul-de-sac, and it looks like it would be single-family homes. It just so happens that the homes are attached. 2 homes are attached.
So let me stop you there. I just want clarification. So this is a duplex.
It's a duplex, but they look like single-family homes, but they are literally attached.
So did your client purchase both?
Nope.
Okay.
Just one. So he bought essentially half a duplex, and that's just what it is.
Great.
Yeah. So, and by the way, we bought this because, and let me tell you why we like a property like this. Because we can buy it cheaper, a lot cheaper than a single-family home. Because just think about it. Would you pay more for a home that's attached or unattached? Obviously, you're going to pay more for an attached home. But tenants don't really think that way. This is an important subtlety. Tenants are there for a year or 2 years or 3 years. So they don't say to themselves, I'm not going to buy this because it's attached to another property. So if you do the math in your head, what happens is we can buy it for a lower price but still get the higher rent. That's how you get cash flow. Just one of a million little tricks that we employ.
Beautiful. So what about the property?
Okay, so it was 4 bedrooms, 3 baths, 1,267 square feet. It was actually a 2-story, and it had a basement in addition, 1-car garage, which you see on the right there. It's a lower middle class area. I would definitely say it is not middle class. I and my clients happen to like that demographic, the middle to generally lower middle class neighborhood. This is a very typical property that we would buy. This is one of the many things that you're going to have to think about. You might say, no, Charles, I want more cash flow. Great, you're going to go to a lower end neighborhood. You might say, Charles, I want to make sure that it's safe and that I want to be comfortable there. You're probably then going to move up to a middle class neighborhood. What I'm going to tell you is there is no absolute answer. You read lots of books, and the books say, you have to buy in this type of neighborhood. You have to buy in that type of neighborhood. That's because they have to sell books, and they have to pretend they know what they're talking about. My experience is a lot of it depends upon where you want to do business. This happens to be a lower middle class neighborhood.
Let's take a look at the pro forma.
Great. Yeah, let's go through this. Let me walk through the numbers.
Okay. We're going to try and go through this quickly, Charles, but I do also want to make sure that the listener is clear that you've agreed to offer this tool as one of the parting gifts at the end of today's class if they're willing to share their feedback about what they learned today. Is that right?
Yeah, absolutely.
Okay.
It's an Excel spreadsheet. It's really simple. You just type in the inputs, and then you click on the next screen, and it'll tell you something about your purchase.
Okay, so let's go through this real quickly. So we've got the property address here that we just addressed. Its number of units is only 1. Purchase price that we saw on the last slide. $5,000 rehab costs were put in?
Yeah, it was kind of a paint and carpet sort of thing. It was about $5,000 paint, carpet, and that was about it.
Yeah. A little lipstick, and you can see there instant equity.
Yeah, he had some equity, but he's not going to sell it. I mean, this guy's holding these forever. So is that after repair value really 115, 125, 130? Frankly, I don't know, because we wouldn't know until we sold it. But the fact is, we don't really care, because what we care about is his monthly cash flow.
So mortgage interest, 4.75 over 30 years.
Yep.
20% down payment.
Yes.
And that down payment, keep in mind, folks, that if you actually are executing the techniques that we teach in the 100% Debt-Free for Life class, you don't necessarily have to have 20% in your back pocket to put down. You can actually get that down payment from other sources, put less than 20% down, but the actual first mortgage requires that down payment and would be an 80%, maybe even 75% loan to value.
Yeah, you'll get a slightly better rate at 75, and that's a point I want to make here. Back in 03, 04, 05, 06, we were buying these things for non-owner occupieds for 5% down. The fact is that doesn't exist anymore. And that is definitely going to be an issue for some people, because if you don't have some cash, if you have no assets, you're going to probably need to build up these down payments. Right now, for a normal conventional loan, the minimum is 20% down.
And this is an argument that Charles and I have had on multiple occasions when we're presenting classes together, where I argue that if you got access to cash from a debt weapon and used it as a down payment, technically speaking, if you obtained 15% of your down payment from that debt weapon, or even the full 20 or 25% that you need to put down from that debt weapon, technically speaking, it's still a 100% combined loan to value financed property.
Right.
It's not cash you had in a checking or savings account per se. So there are additionally creative ways to get in for less out of pocket. And we do have a little to no money down investing class that we did with a mutual friend of Charles and mine. But keep in mind that Charles is the ultra-conservative educator, which I really like about him. I, too, like the ultra-conservative approach. However, we can't ignore the fact that there are still creative ways to get into a property with less out of your own pocket.
And I've seen them done, and some of my clients have done them. So you're absolutely right.
Okay, so as we go forward on this pro forma, we've got a unit number 1 at $1,250, and the reason that these others aren't filled in is because it was a 1-unit property, even though they bought half a duplex. Okay. Vacancy factor, you already account for that. That's great.
Yeah, I put in 5%. Right now, it literally is 2% in our market. Put in anything you want. You want to be more conservative, call it 8%.
And then I see here on the operating expenses, you break these out annually, which is good. You've got the taxes, insurance, as well as the maintenance factored in already.
Yeah, we figured $750. Obviously, we don't really know. Maybe the person will stay for 2 years and it's nothing. Maybe they'll leave in a year and we have to paint or something like that. Okay. $750 is about right for a property like this.
Okay, so when we flip over to the next tab, which just so you're aware here on the bottom of the page, there's 2 pages here that you will have access to when we provide you the gift of this spreadsheet. You can see that some of this data has transferred over onto this other page, but you can see here the down payment ended up being $19,000.
That's right.
That was the 20%. And then the loan costs $36.25.
Yep. So he just got a normal conventional loan. That's what it cost him. I just pulled it off what they call the HUD-1, which tells us what he paid.
So the total investment here was the $27,625?
Yes.
Okay.
Yeah.
And then the rental income ended up being about $15,000 a year.
That's right.
So that netted out $14,250 after you factor in the 5% vacancy, which was conservatively rounded up.
That's right, yes.
Okay, so let's look at the other expenses that you had accounted for on the previous page. Total of $1,987 annually for a net operating income of $12,283, or $263 rather.
Yes.
Okay, so how does this all work out in the end?
Okay, so here we get some numbers right here. And this is where you have to decide how much you want to get into this. There are lots of different metrics you can use. There's cash on cash. There's 5-year return after taxes. There's cap rate. There's the net operating income. There's so many different ways to do it. We choose a couple right here so that we can basically compare this property to the next property we look at. So the first time you look at it, well, you're not going to really think too much about it. We're going to talk about it. But what's going to happen is after you've looked at 10, 50, 100, you're going to say, this 101st one is the best one I've seen. And that's where it's really going to get relevant. So what we have here, for example, on line 43 is the annual cash flow before taxes.
And if you can't see 43 here because it's slightly cut off, annual cash flow before taxes, $7,500.
So the cash on cash rate of return, that's a really important one. So let's say you take $1,000 and you buy a bond, and you get 1% interest rate, which is about what you're getting. The cash on cash rate of return for that bond is 1%. Here, the cash on cash rate of return, given all of the elements we put into this, is 27.2%. That's why we're talking about this.
And that's taking the annual cash flow before taxes and dividing it by the total amount invested.
That's correct.
And that's where you come up with the 27.2%.
That's right.
So in theory, going back to what I was saying earlier, if hypothetically a student were to obtain a debt weapon in the form of another tool where they had access to capital, they used that money as their down payment, but it was not sourced from their back pocket, That would mean they had less of their own money into the property, which would mean that this number would reduce. However, this number would probably be reduced slightly because they may have additional liability, right, where they have to service more.
Right.
But perhaps this number could increase because they have less money out of their own pocket. Is that right?
That's right. So I want to make you understand this is a fairly normal deal where I work in Denver, Colorado. And this is probably going to be what the numbers look like at the end of the year. There is nothing speculative about this. And let me just show this one more time. You took $27,625, you bought a property, you fixed it up, and you got the loan. In the first year, you're going to make something like $7,506. The return is simple division. It's 27%. This is why you think about maybe doing this. There's some work, there's some risk, there's some effort, but you're not getting 1%. You're getting 27 times that. And by the way, have you heard me say anything about appreciation? This is not including appreciation.
Or depreciation.
Or depreciation. And that's very important because I'm not going to sit here and speculate that this property is going to go up 3%, 6%, or 10%. Now, I will tell you, right now in my market, this neighborhood has gone up 11% in the trailing 12 months. That's just what's happened. But we don't even include that. The best number you can use is about 6% appreciation over the long term. So that would be 6% of 95,000, which would be another 5,000. So if you care to do that on your own, that's great. I'm not here trying to lead you down a path. I'm just telling you, without appreciation, this is about what you'll make in the first year.
It's phenomenal. Now, what I want to talk about real quickly, Charles, is the power of cash flow stacking. And we only alluded to this in the 100% Debt-Free for Life class. So if we were to expound on that slightly by bringing in an additional case study to this presentation, you're going to see the magic of the compounding impact of multiple properties playing a role in this. So ultimately, when we talk about getting out of debt, we explain in that first class that you can flip these amortization schedules upside down and truly avoid the vast majority of the interest that you would otherwise pay regardless of how great or poor your starting interest rate is over the term of your fixed mortgage, whether it's a 15-year, a 30-year, makes no difference. And Charles, you've seen this class now
for years, yeah.
Years and years. What is your impression of utilizing these techniques inside a real estate investment portfolio?
Okay, so let me start by saying you don't have to utilize these techniques. Everything that I've just talked about should come true over the long term, and you should be able to pay off your property 13, 15, 17 years, something like that. That's what people like me have done for years and years and years. What Matt talks about accelerates things so fast, it's almost unbelievable. And having worked a radio show with Matt in the past and having been to dozens and dozens of classes that we co-teach together, I usually tell people at the end of the class, I know you're blown away. I know you don't believe this. What you need to do is sit down with Matt. He will show you every single number. The math actually works. There is no speculation. The short answer is if you use the cash flow stacking techniques, you will pay off these properties much, much faster. It is just a mathematical certainty.
Absolutely. And the reason it works so well is because you're essentially taking debt weapons and you're utilizing those debt weapons for purposes of income-producing asset acquisition. And then you begin to paycheck or rent check park that extra cash flow, and that process is cyclical. So it just continues over and over again. So what I'd like to do is reference another case study. I'm going to bring Josh Hansen into this equation because I think he can explain it best and show you the power of how this exponentially will build on itself, where the momentum increases so quickly that you can begin to own properties free and clear in a matter of a couple short years versus 10, 15, 20, or 30. So let's go ahead and introduce Josh Hansen into this story, and then we're going to go into exactly what debt weapons are in order to remind you about that, because those are the key tools in order to allow cash flow stacking to play a role. So Josh and I met about 2 years ago exactly, and Josh had attended one of our live classes, came back to another live class with his business partner, and at the time had already dipped his feet in the water, so to speak, with real estate, had a couple cash flowing properties, but really wanted to take it to the next level. And we were teaching a class about that very subject, not a whole lot different than what we're teaching here today. And during that, we exposed him to the concepts of cash flow stacking, and he really took it to places that very few have, and has kind of become the poster child of these techniques. I want to go through the details with him. But I want him to kind of share what his first impression of the information was when he first saw how to use lump sum payments, how to use debt weapons, how to use cash flow stacking, and how it related to acquiring a portfolio of real estate. So Josh, how are you doing today? And thanks for being here.
I'm great, Matt. I appreciate you having me on.
So what exactly did you think of the information when you and Scott first attended the classes?
That's a great question. When I first saw this concept, I was very skeptical in nature. By trade, I'm a CPA, and so I am a numbers guy, so to speak, and look at everything very analytical. I can tell you when I first took the class, I was asking myself the question, why didn't I hear about this before? You never really heard the concept. You never hear other investors talking about this. And so when my initial impression on this was a very high level of skepticism, but after sitting on it for a couple of weeks, I decided, well, maybe it's really worth my time to sit down with these guys and understand what this concept's all about. And at the end of the day, it really aligned with my goal. And my goal from the very beginning is to build wealth. And how to do that was through the vehicle of cash flow real estate.
Okay. So when we first met, how many properties did you have? Do you remember?
When we first met, at that time I was at, I think, 4 properties that were decent cash flow plays, but nothing spectacular.
And so we're now at 2 years later, and how many properties in total do you have with and without Scott?
Well, I guess just to kind of clarify, so Scott is my partner, so I can't say that I own this, real estate 100%. I wish I did, but having Scott has been fun and exciting for us. But with Scott and myself, I'm up to 22 properties today.
Okay, that's phenomenal. And obviously, not everybody listening right now has that same goal. Maybe they want to own one. Maybe they want to own twice that many. That's fine. The concepts apply either way, right? You and I were talking before the class today about the misconception of either increasing your assets and your wealth or eliminating your debt, but not being able to do both simultaneously, right?
Yeah, that's correct, yeah.
And you've been able to successfully prove that both can be done. In fact, the way that you've acquired income-producing assets has allowed you to accelerate the elimination of your debts and use the cash flow stacking technique. So let's go ahead and start demonstrating that now. We've got Josh's cash flow cruncher here, and this is going to look familiar to you from the 100% Debt-Free for Life class, okay? So you've got your cash flow summary page, revenue and assets, the debts page, living expenses, business expenses, action steps, and the loan calculator. Now, this is just a snapshot of the real estate section of the cash flow cruncher. So I don't want you to pay attention to anything other than the revenue and assets and the debts. What we're going to do is go through a chronological history of Josh's activity buying real estate and what that's meant from a cash flow perspective, and then how cash flow stacking actually works in a 202 format where you can accelerate the elimination of each one of these mortgage balances almost more quickly than is believable, right? Now, you had come running up to me a short time ago at a Real Estate Investor Success Summit, which is one of the largest conventions here in the Denver area. And if you don't know Josh, he's about 7'6", so it's very easy to see him in a crowd. There were probably 400 or 500 people there, and he noticed me, I noticed him, and we kind of met in the hallway. And what did you say to me at that time?
Well, just for clarification, I'm only 6'7". I'm not the Yao Mings out there, but nonetheless, I do tower over a lot of individuals out there. But I ran up to Matt, and I was so excited because I hadn't seen him for just a little over a year. And I went up to Matt and said, Matt, you won't believe this. Paid off my very first property in 20 months, debt-free.
Debt-free, mortgage-free on a property in 20 months. So if that piques your interest, here's how it was done. Right now, let me ask you this before we dive right in. Do you happen to recall the total amount of interest that you paid on that one property?
I think I could pin it down to $5,876.23.
So yeah, you can see Josh is a CPA, obviously. He cares about the numbers.
So just over $5,800.
Okay, and is that property here on this list?
It is. It's the very first property, 100th Circle.
So it was the first property that you bought. And we do have a specific format for which properties we would target first, and there are a number of different factors that need to be considered. So don't try and run with this as your specific circumstances, because you may not pay off the first property that you acquired versus other properties. So there are certain things you need to think about when it comes to that. But it just so happens that the first property that Josh acquired was 100th Circle. What was the mortgage payment on this when you first acquired it?
The mortgage payment, I'm going to refer to PITI, principal, interest, taxes, insurance, all in was just around $600.
Okay. Now, what was the total rental income, which I'm going to put on the revenue and assets page? And by the way, keep in mind that if you haven't had your personal implementation coaching session yet, after watching the 100% Debt-Free for Life class, that is a free consultation. We show you some of this, and you will also get your own free copy of this cash flow cruncher. So if you don't have this yet, make sure you watch that class again, fill out the feedback form, get your free session, and we'll email you a copy of this spreadsheet. So on the revenue and assets page, we're going to go ahead and put the rental income that will offset the expense of 100 Circle. So what was the revenue that was being generated on this property every month?
$1,400.
Now, when you insert the $1,400 revenue, you can see on the cash flow summary page, the mortgage is listed of $600, PITI, and the revenue and assets of $1,400 was also listed, whereas you can see the net cash flow is now $800, right? Now, if we were to use cash flow stacking with just one property, Josh, we have a specific formula where we would take a specific lump sum amount from a debt weapon and apply it towards that mortgage that is all determined based on the amount of cash flow. Now, in this case, that number would be approximately $10,000, whereas we know we could do that about once a year. So in this case, if we were to take that mortgage balance of $93,000, let's call it 4.5%, which puts us at $471 principal and interest. Then we have the taxes and insurance on top of that. So that would put us right at about $600, right? Okay. So in month one, if we were to follow this specific cash flow stacking formula on this loan calculator page, we could, from a debt weapon, borrow $10,000 and apply it towards this first mortgage. And by doing so, we could prevent $23,900 worth of interest. Now, over the course of 1 year, you will have interest payments on this $10,000, but it will be significantly less than the $23,000 that you just saved. And in 1 year's time, down here on month 12, you could do the same thing again. So you can see now you've saved $39,000 plus in interest. And that process is washed, rinsed, and repeated. That is cash flow stacking with just one income producing real estate property. But Josh and his partner did not want to stop after one. So I just want to show you the power of how this was accelerated and demonstrate how it's possible to pay these properties off in, what did you say? You paid this one off in
20 months.
20 months. Okay. Now, this property was purchased right around the same time that we met you. Okay. A couple months after that, you went on a buying spree, right? You purchased several properties in a row. So which of these properties did you buy after 100th Circle?
We bought Biscay Street, Carson Way, Humboldt, 55th Avenue, and the very last one at the bottom, Tennessee Avenue.
Okay.
All in the following spring.
And why is Tennessee at the bottom here?
The reason we have it at the bottom there is because there's 4 units within it. It's a fourplex, so I count those as 4 units. They're each separate properties or units in my mind. And
okay.
It's easier to track that way.
So you bought these 5 properties, Biscay to 55th and Tennessee. What was the timeline that it took you to buy those?
3 months.
Okay. So let's go through those one at a time and include the mortgage payments, and we'll go back to the revenue and assets page and put in the income that you generate from each one. Okay. So what is the principal, interest, taxes, and insurance payment? And by the way, just so you guys know, it doesn't hurt to take your taxes and insurance and put that on the living expenses page because it is an expense that will continue even after the debt is paid off. But for purposes of this example, let's include the full amount in order to make sure that the cash flow is accurate. Does that sound good?
Yes.
Okay, so what is the monthly principal, interest, taxes, and insurance payment on Biscay?
$600.
And how about Carson?
$565.
Humboldt?
$545.
55th?
$575.
And then Tennessee is a fourplex. What is the monthly payment on that?
$1,660.
Okay. So you can see, going back to the cash flow summary, now we have a lot more in the way of expenses. So the mortgage payments have brought the outgoing to $45.45, and the revenue and assets is currently only on the 100th Circle of $1,400. So now this would be negative cash flow if those properties were vacant, which they're not. Obviously, they're rented. So let's go to the revenue page and offset those expenses with the income. So what is the revenue on Biscay?
$1,340.
And how about Carson?
$1,215.
Make sure everybody can see that. And Humboldt?
$1,285.
55th?
$1,235.
Wow. Okay, and Tennessee is the big one, right?
Yes.
What are you getting on that one?
4,800.
4,800. So you're renting those on average for 1,200 a piece.
Correct.
Wow. Okay, this is going to be amazing. So now you can see the total income has increased to 11,275, right? And I think I see where this is heading. On the summary page now, you're netting cash flow of $6,730
Per month.
per month. Okay, that's phenomenal. And you did this from the first property on 100th through the final property on Tennessee in what time window, approximately?
6 to 7 months.
Okay, so in 6 to 7 months, you were able to increase your monthly positive cash flow to $6,730 every single month without factoring in what you were earning on your day job of you and your wife both being a CPA.
That's right.
Wow. Great. Okay, so when you properly use cash flow stacking, this new $6,730 amount can be applied in the form of a lump sum payment. So in theory, I know that if I take $6,730 and multiply that times 12, and I borrow that amount from a debt weapon, and then I paycheck park against that debt weapon, in theory, that dollar amount is paid back in approximately 1 year's time.
That's right.
Before interest.
That's right.
Okay.
Interest.
And the interest amount is so small that it generally is paid back in a year's time or faster. Okay. So let's do those numbers quickly. How long would it take to pay off $93,000 on a loan amount with a positive cash flow position of $6,700? If we took $93,000 and divided it by $6,700 in positive cash flow, you'd be able to pay that property off in about 14 months. Now, the reason you didn't is because you were acquiring those properties over the course of a 6-month period, right?
Right. Between that and some repairs and maintenance. But this is exactly the model that we implemented. And that's what's so key here is exactly what you're walking down is what we did. Now, we didn't make it the payments every single month.
Of course.
It'd be every 3 months.
Of course, which is the lump sum payments and the paycheck parking element. We don't even call it paycheck parking at this level. We call it rent check parking. There are a lot of different techniques to make this work properly and in your favor. There are a number of ways to do this and do it to benefit yourself versus what the bank is asking you to do. So there's not necessarily a right way or a wrong way as long as we agree that the one and only wrong way is the way that the bank is asking. Because the fact is the bank isn't in business to make you money. The bank is in business to make themselves money, and that's perfectly okay. But this is teaching you a way to benefit both you and the bank. So let's go back to the debts page and go through the rest of these so you can see how things are looking currently for Josh. So what is the current monthly mortgage payment, principal, interest, taxes, and insurance on Avenue?
$660.
And 55th?
$480.
Okay, and Harvard?
$580.
Alrighty, and how about Deep Haven?
$600.
All right, and Genoa?
$580.
Biscay?
$590.
And Hooker?
$600.
Okay, so let's go to the revenue and see what the offsetting numbers on those currently are. What's Avenue?
$1890.
So you're renting it for $1890. That is phenomenal. 55th?
$1,200.
Harvard?
$1,175.
Deep Haven?
$1,265.
Genoa?
$1,175.
Biscay?
$1,350.
And Hooker?
$1,400.
Look at this. Total revenue, $20,730, which means that the cash flow currently is approximately $12,095 positive on average each month, notwithstanding vacancies and unexpected repairs, etc. But I think you have a pretty good chance of covering those things when they come up here and there.
We have a pretty good foundation today.
I would say so. Now, this is why you get into real estate, okay? If you were wondering before, I'm guessing you see it now. Josh is one of the enormous success stories that are out there. And again, you don't have to necessarily set your sights on the same goals that he has. Your goals are going to be different, and that's okay. It might be more, it might be less. The concepts apply at any level, which is why we wanted to show you that it works even with one property. And you'd be doing these techniques even if you only had one in your portfolio, right?
Well, that's a great point, Matt. My underlying goal is quite simple. build wealth. And you said it best, is we want to increase our asset base and pay off debt. A lot of these properties may not appreciate, given the environment we've been in the last 3 years. Today, we're using it to pay off debt and acquire more properties.
Now, one quick thing I want to point out that's really meaningful here is that 100th Circle you ended up paying off, right? Correct. So you paid this one off in 20 months with a total of $5,800 and whatever the rest of that number was that you gave in interest, right?
Yes.
Okay, and once that was paid off, you did something very special.
We got another debt weapon on this property in the total of $95,000.
Okay, so this one was paid off to zero, and then you went back and acquired a debt weapon where you could access $95,000 if and when needed, which you then would use to acquire more income-producing real estate.
That's right.
What an unbelievable cycle. I want to point out one other thing. Josh is a highly knowledgeable individual as it comes to both accounting and bookkeeping. So Josh and I are putting together a really exciting class where you can learn everything you need to know about keeping your books in order, which is another form of proper utilization of debt weapons. When you properly use debt weapons, you'll see here shortly that the number one benefit is maximization of cash flow. And keeping your books in order allows you to do that. So even if you're in coaching, this is a very important piece to your puzzle, which is why we're going to bring you that class. Keep your eyes open for it. And with that being said, I really appreciate you being here and sharing your story. Thanks a lot, Josh.
Thanks for having me.
Okay, so that is absolutely remarkable, but I'll tell you right now that you couldn't achieve results like that without the proper utilization of debt weapons. Real quickly to remind you, debt weapons allow you to maximize your cash flow, compress amortization schedules, create better bank accounts than the ones you have now. Charles had alluded to really the fact that we're shortchanged on our checking and our savings accounts at the bank. And look, they're just doing good business. The difference is that when you're properly educated, you can create a more mutually balanced relationship with the banks where you're using what they're already providing you in a way that benefits you more than you've probably been taught before. You invest more quickly and safely, as we're showing you here in this class, and you can minimize the total volume of interest you spend throughout your lifetime by 3, 4, 5 times what you think you probably are capable of. And finally, you get to enhance your FICO scores further, which we're going to talk about in just a few moments. You do need a 700 or better FICO credit score in order to achieve getting between $2,000 to $150,000 per debt weapon that you are pursuing. In order to go after a debt weapon, the 4 questions that need to be answered include which debt weapon to get, where to go to get it, when you should apply for it, and what purpose will it serve once you have it. I want to emphasize that at no point should you ever be done looking for more debt weapons. When you have access to capital, what Charles has been teaching us becomes far more real. The people that aren't getting involved in real estate for one reason or another, who want to, aren't because they don't have money. So debt weapons solve that problem. We do research every single week, spending anywhere between 5 to 15 hours in order to just answer these 4 questions: which, where, when, and why. So we can help guide you on that. If you have not yet had your free personal implementation coaching session after watching the debt-free class, make sure you take advantage of it, because there are a lot of dangers if you're not using these debt weapons properly. Here are just a couple snapshots of the checklists that we go through, and these are just a fraction of the ones that we've created in order to make sure that we know the answers. Please minimize the credit you have available to yourself if you do not have financial discipline. And we can help you with that discipline if you need it. In the end, debt weapons will create safety for you. Now, one thing I want to point out is that beyond today's class, there are a number of classes that we offer that will help you learn all you can about debt weapons. The one that we're learning about today is the real estate investing class down here, and there are 2 different classes that we have right now on that. But we're also going to be introducing a Mortgages 101 class where you can learn all you need to about the right types of mortgages. Also, how to get access to business lines of credit. Business lines of credit being tools that really don't even report to your personal credit report and don't even require personal guarantee at times. The infinite banking class. This will teach you how to gradually eliminate the need for banks in your life ever again. Residual income, how to make over 6 figures residually and passively where it doesn't cost you much money to get in, if anything at all. Credit scoring, and debt/cash flow. So we talk about all these. Anything in Gold is a free class that we welcome you to attend, and you'll receive emails inviting you to participate online. Real quickly about FICO scores, keep in mind that you want to always shoot for a 760 or better credit score, because you will spend far too much money if you don't have a 760 or better over the course of your investing career. The minimum score you need in order to get access to debt weapons is a 700 or better. Now, there are credit scoring maximization solutions that we can guide you towards that are far more effective than credit repair. And we've been doing that for years and years. We've been actually teaching around the country about credit scores for over a decade. Now, if you are looking to invest in real estate, which I assume you are because you're on this presentation, keep in mind that the credit scoring minimum needed is typically a 660 or better on a non-owner occupied financed loan. However, there are exceptions to every rule as it pertains to lending and underwriting. So you may be able to get access to a seller financed property that really doesn't have this minimum credit score requirement. Just keep in mind that this is standard and you're going to want to always try and drive your credit scores higher. All right, we do have solutions for you that we can guide you to. These are free to VIP coaching students if needed. And the results are really quite remarkable. You can see here on a MyFICO report, the 549 FICO score in this example climbed to a 696 in just 11 months' time. This is just a snapshot of that 11-month period. So you really can be proactive about your credit scores and get exceptional results. Two big reasons to maximize your FICO scores. The first is that it reduces expenses such as insurance, such as interest rates. The other big reason is it enhances your borrowing power. So you can get access to those debt weapons, you can get access to the mortgages you're going to need to buy, and you can get access to the private lenders that are available. Finally, before we close up shop for the day and I tell you a little bit more about VIP and tell you what your next step is, I want to just ask a couple quick questions. I don't want to spend too much time on this, Charles, so that we can get people out of here within an hour. But I want to ask you just off the cuff for a basic answer to each one of these questions. How much money do I need in order to become a real estate investor?
Okay, assuming that we're just talking about someone who doesn't use your services, just a regular person off the street, you are almost certainly going to need to put 20% down. You're going to probably need a few $1,000s for closing costs. At the same time, in your market, there might be a mechanism where you can have 2, 3, 4%, what they call the seller cash back to you. So you're probably going to need something like 25% of the purchase price. On top of that, I would highly recommend you don't do this if you only have a month or two in the bank. We want to be conservative. If you don't have some money, just in case you have a vacancy, in case somebody breaks a window, you don't want to be really tight. You want to have maybe 6 months of reserves just to make sure. Just trust me. Sometimes, very infrequently, but sometimes things go wrong and you don't want to get yourself in a bad position.
So is it true right now that the banks are not lending?
Well, it's absolutely not true, and I hear that all the time. I mean, like I said, I've closed 88 deals so far this year. I close a lot of deals. The banks are absolutely lending. Why people say this is because are the lending criteria more difficult than they were in 06? Yes, they are. The question then is, shouldn't they be? And quite frankly, I think they should be. What happened is everybody got a loan in 05, 06, 07, and then half of them lost their properties. If you have a reasonable FICO, if you have a job, if you make money, and you sit down with a lender, you probably can get a loan, no problem. The next question you might have is, well, what if I'm self-employed? Can I get a loan? I can't get a loan. That's not true. You can get a loan if you're self-employed, but you have to have taxes that show you make money. I'm self-employed too. I understand about self-employed people and how they make write-offs with their taxes. Being self-employed is not a problem. Having a tax return that does not show any income is a problem, and you will almost certainly not be able to buy a property if that's the case.
So how much does location and condition play a role?
It plays a role, but very subtly. So you have some folks who say you always have to buy in this kind of neighborhood. I disagree. You can buy in any kind of neighborhood. In my market, typically the lower end neighborhoods and the lower end properties, so that's the condition part, almost always give you a higher monthly return. My guess is you're going to find the same thing in your market. So what I would say is, I think it was step 3 or something, go out, look at the market, figure out what one neighborhood will typically give you for a return, figure out what another neighborhood and another neighborhood, and then make some choices. But there's no such thing as you have to buy here or you can never buy there. It's just not that easy. That's why you need to take some time to figure this out in your market. And again, if you give me a call, I'll be happy to chat with you about that sort of thing.
So is multi or single family generally better?
Great question. It doesn't necessarily matter. Look at the numbers, figure it out. The one thing with multi, duplexes, fourplexes, is you are going to have neighbors that sort of irritate each other. I like single family better, but the numbers should drive your decision.
Great answer. So is it better to fix and flip or to buy and hold?
It really depends on what you're looking for. This discussion has been about buying and holding. I do have some fix and flippers, but frankly, these guys are pros. If you are just getting into real estate, I would suggest that you not get into fix and flipping. Yes, the short-term returns can be much higher, and so can the short-term disaster. I like buy and holds for people because I think you have a much, much lower risk of getting yourself into trouble.
So I know how I would answer this question, but where would someone get their investment advice?
Well, I mean, you start by giving me a call, and most likely you're not going to be in my market, so I'm not really trying to sell you anything. I just like talking to people, and I want to learn about different markets as well. What we need to do, if you want to learn more about this, is find a person in your area that's like me, that's an honorable person who does this and is looking for a long-term client to counsel you through this whole process.
And I can tell you right now, if you already have a real estate agent that you trust, that's half the battle. So make sure that you remain loyal. It goes a long way. So what skills does it take to be a real estate investor, Charles?
I think it takes patience more than anything else. I think it takes patience, being able to solve problems, understanding that sometimes you have a bad day. Sometimes your lender might say, hey, we have a problem, and you have to fix it. Sometimes your tenant might say, we have a problem. It just takes the ability to not freak out about things, to have the time, to have the patience, to have the understanding that this is a long-term plan. This is a business that you're building. You're going to have good days, you're going to have bad days, but in the end, you're going to make a lot of money. You're going to do a lot of good.
I love that. Patience. And it kind of leads into this next question. What if somebody has bad credit, no money? I'm going to answer this one for you. Watch the 100% Debt-Free for Life class. It's a perfect starting point. We're going to dive into the natural organic way to raise your credit scores, the natural organic way to maximize your cash flow, and then we can qualify you to become a 3D affiliate where we can help you start making more money. Sometimes it just boils down to you need to make more money, and that's okay. We can give you solutions there as well without selling you something. What is a good rate of return on an investment property? And we already covered this slightly.
It depends completely on where you are. If you're in San Francisco, you might be making 4%. If you're in Detroit, you might be making 40 to 45, maybe 50%. And again, give me a call. We can talk about this. In my market where I am in Denver, Colorado, typically 16 to about 28% cash on cash in the first year is what we are actually getting. But it completely depends on what part of the country you're in.
And finally, what are your thoughts about hard money?
Hard money being basically you go to a guy or a company that has lots of money and they'll lend it to you, but their terms are tough. You might have to pay it back in 6 months, pay maybe 4 points, 12 to 15%. There is nothing wrong with hard money if it's the right and proper use of it. This means you have to understand everything about the hard money. I have lots of clients that buy with hard money and then they refinance after they fix the property up at a higher value. It is a perfectly legitimate business, but you need to know what you're doing.
It's also a great way to get in with less out of your own pocket. So you may want to attend the Buying Real Estate with Little or No Money Down. It will talk in greater detail about hard money. A little bit about VIP, if you're unfamiliar. VIP was founded in 2002. We started with the help of 44 mentors and experts, in fact, Charles being one of them. We became national leaders on cash flow, debt, and credit, and all of our online and on-site classes are provided for free. So we provide all of the education at no charge. Implementation and accountability for the services, that's where we make our money. So we do offer subscription-based coaching to help people put to practice what they learn in our classes. But I will say that not everybody qualifies for those. We're very strict about who we allow in. And the reason for that is because we want to continue to protect our perfect reputation, so we do guarantee results. That's why our pre-qualification process is strict. We do have countless testimonials. You can go to aboutvipfinancialeducation.com to see more of those success stories. We've been providing our classes and training to many companies over the years: NASA, Chicago Title, Carey, Remax, Your Castle Real Estate, which Charles owns, IRR, Foundation for Financial Wellness. The list goes on and on and on. This is a testimonial from the Chief of Police. When I first saw this, I thought, holy smokes, it was very informative and a great process. We love having the classes at the station, and we are really making great progress with our coaching and can't wait until the next class. That's from Jim May, Chief of Police in North Glen. Here you can see our A+ rating with the Better Business Bureau as well, and the fact that we've taught these classes for NASA at Johnson and Kennedy Space Centers. This testimonial is that I am the program director that's been offering the VIP debt-free education to the employees of NASA, and we've received wonderful feedback and plan to increase the availability of the curriculum. In one word, awesome. I would strongly recommend this information to anyone, and that's from Karen Myers. We're obviously very proud of that testimonial. but it does show you that even the smartest people in the country get a lot out of this content. So what are you supposed to do with the information that you got today? Hopefully you learned a lot. The first is you want to complete the feedback form that's going to pop up on your screen at the end. He's going to call you directly, and if you call him back on his first attempt to reach you, if he misses you, then you will get a free copy of his book, which is a real estate investing book, 2003 guide. So what you're going to do is start to begin designing your short-term plan by reversing your long-term goals. Keep in mind that we will provide you a copy of the Cash Flow Cruncher as well. This Cash Flow Cruncher spreadsheet that Josh Hansen uses and every other student of VIP will be free of charge for you. You can use that to manage your cash flow. We're also going to provide you a copy of the spreadsheet that we demonstrated, which was the investor analysis spreadsheet. So you'll get a copy of that. I also recommend that you go to mint.com. Mint.com is a free service provided by Intuit, the creators of QuickBooks and Quicken, and it will interface with your banks where you can set goals. So your feedback is really what we're after here today, and which is the whole reason we're providing you this education for free. Please complete the feedback form so that we can give you the gifts that I'm going to describe now. The first is the free no sales, no pressure counseling session with Charles, right? So, and what can you say about this session that they're going to have with you?
You know, you're going to give me a call, and I don't know who you're going to be or what you're going to say, so I'm just going to chat with you. And honestly, you might call me, and I might say, you know, Bob, I think you shouldn't be doing this, or I think you're not ready for this. It's just going to be my reaction, so I don't know what it's going to be. Another person might call, and I might say, you know, Jennifer, I think you're the type of person that my client is, that you might really, really gain from it. So I invite you to give me a call. We chat on the phone. Again, I'm not getting anything from this. I'm not charging you, and you're probably not going to be in Colorado, but I like to talk to people about this. This is what I do all day long, and I always learn something from people I speak with, and that's really a lot of my motivation for wanting to chat with you.
Well, I really appreciate you doing that for everybody. You will be gaining a free referral to a qualified agent in another state if Charles can't help you, if you don't have one already. Again, work with the agent that you have if you have a loyal relationship already. You'll also get a free qualification to become a 3D affiliate where you can share classes just like this and earn up to 6 figures a year to help people. It doesn't cost anything to become an affiliate, and it's a great value add even if you already have another business. You'll also gain access to all of our other free classes, so the invitations will be sent via email. You'll get the spreadsheets that we walked through, and then the free book about today's investing class if you call Charles back on his first attempt to reach you if he does miss you. So this is your chance to determine if and how real estate investing can improve your life. If you'd like to expedite your process, you can call to reserve your free session. Call us and we'll refer you to Charles. The number is 866-969-2738. Please leave a message if necessary. We do our best to call you back promptly. However, we do have a lot of demand, so please be patient. We'll get back to you as soon as possible. We really appreciate you joining us today for this class. Charles, thank you so much for being as generous as you always are and helping people, lead themselves down a path of success.
Thanks, Matt.